WTI crude has dipped below $99 a barrel, while Brent continues to remain near 110. Here to talk about that spread with us is Dan Dicker. As always, Dan, great to have you here in the studio.
Thanks, Joe.
So, Dan, what do you make of this?
Well, we've got a major trend that's going on, and this has gone against what a lot of the analysts have been saying, and to be truthful, what I thought might happen going into the fourth quarter. But we've got to make a tremendous note on this, because what has happened is that we've seen a continuing surplus of crude in Cushing, which is the basis of American crude oil. And we've got that for two reasons. One, we know about the increased production that's going on through the various shale play areas of the Bakken, the Eagle Ford, into the Cline and the Permian Basin. That has added a certain amount of oil into the mix. But what has really kind of taken an enormous surplus and caused these increases in supplies over the course of the last 5 weeks, I'd say, is because of refinery outages in the Gulf Coast. Now, if refiners aren't pulling down crude oil out of Cushing, it sits there and you get this glut. So that's what's been going on in the United States. In Europe, we have an opposite factor going on. We have a shortage of crude because we have geopolitical problems in Libya.
Right.
And of course, Europe is, again, it's really, the recovery story is very, very strong in Europe, and particularly Eastern Europe. And that is sucking what has been a very small supply of crude. So what you have is you have a very static price basically in Europe of $110, very expensive. And you have this slow sinking of an American benchmark price here in the United States.
Yeah, I mean, we saw an inventory build from the October 11th week, which finally came out after the government shut down. Tomorrow, Wednesday, we're expecting another build of about 2.7 million.
It's been 4 or 5 weeks in a row, and I don't expect the trend to end with tomorrow's report.
You don't? Okay.
No. I expect another build again because the market's basically telegraphing that to you with this spread that goes from 6 to 8 to 9 and now is over $11, which is quite a premium for Brent to have.
Yeah, considering over the summer we actually saw parity.
We did, and actually we saw WTI for a brief moment go over Brent, which is really the historical norm for the two crude benchmarks. But you know what that means for us here in the United States and what it means for our stock investing is fairly serious. We know that Brent really represents the more global price, and WTI is almost an anomaly that kind of represents what a certain number of E&P companies and a certain number of refineries can capture in a certain area of the country. Now that's not insignificant, because what it'll do is it'll put some pressure on some E&P companies going into the fourth quarter, and it will add a little bit of a tailwind to some of the refiners going into the fourth quarter. So those are the two major trends we want to look out for, but we want to keep a real good eye basically on this spread. That's going to tell us exactly what's going to happen.
So let's break it down real tight for anybody looking into stocks right now on what we just discussed. What do they do and what do they go for?
Well, I'm not going to mention too many names here because it gets too complicated, but I would say be more wary of those high beta E&Ps that have been running. And most of them have. The average E&P is up 45 or 46% for the year. And be a little bit more wary of, in fact, the refiners who have started to make a move back towards where they were, 8-10 months ago, when the spread was also way out of where it is going now, and trying to find some opportunities in the refiners to buy, a little more wary in the E&P companies.
All right, Dan Dicker, as always, thanks so much.
Right.
You heard it from Dan. For The Street, I'm Joe Deaux.